Hello, my name is Evan, and welcome to Economics 101, your number one source for everything economics. Have you ever wondered why the stock market keeps going up no matter what? Even if inflation is high, even if people are struggling, even if the economy feels uncertain, it just continues to keep going up. What's really going on here? Because if you zoom out, something bigger is happening. We've all heard the term, the rich are getting richer, the poor are getting poorer. The difference is, in 2026, the rich are getting significantly richer and faster than ever before. In today's video, we're going to break down three important topics: why the stock market continues to rise no matter what, how Federal Reserve policy is driving asset prices, driving up asset prices, and why the system benefits the wealthy the most. Before we jump into the video, I have a quick favor that really helps grow the channel. If you find this kind of content useful, consider liking the video and subscribing. It tells the algorithm to push more content like this out. So it helps me out, basically. So let's go ahead and get into the video, though. What's the market disconnect? Okay. Here's the strange part about today's economy. The stock market looks stronger than ever, but the average person doesn't feel that strength. We've seen major indexes continue trending upward, driven largely by big tech dominance, the Magnificent Seven. You got AI-driven optimism and strong corporate profits that continue to make things feel or seem like the markets are stronger. But wages, they haven't kept pace, okay? This creates a disconnect where assets go up, but your purchasing power feels stagnant. And that's the first clue. The market isn't benefiting everyone equally, okay? Now, we know the Fed is the backbone of our economy, okay? To understand this, you really have to look at the Federal Reserve as a whole, okay? Over the past decade, and especially since 2020, the Fed has kept interest rates historically low, until rate hikes recently, injected trillions into the economy, and they supported financial markets during crisis. Even now in 2026, expectations around rate cuts or pauses continue to influence markets. Here's why that matters. Lower interest rates equals cheap money. Cheap money equals more investing. More investing equals higher asset prices. But who owns the majority of assets? Okay? It's not me or you. It's more than likely the wealthy, right? That 1%, that 1% of the 1%. So the people who benefit from higher prices, inflation, things like that, are the wealthy, okay? Now let's shift it a little bit. We're going to compare inflation versus assets, okay? Inflation hits everyone, but it doesn't affect everybody equally. When prices rise, you have rents that go up, food costs increase, everyday expenses get tighter, but asset prices also rise. So when you have the things that me and you are, things that affect me and you the most, when those prices go up, asset prices also go up. Stocks, real estate, business equity. So while inflation erodes cash, it inflates assets, all right? And again, who owns most of the assets? It's the wealthy. It's the top 10%. I said 1%, but it's the top 10% of earners who hold the majority of things like stocks, okay? That means inflation, ironically, can widen the wealth gap. Quick pause, guys. If you want more breakdowns like this that actually explain what's happening in the economy without all the economical jargon, make sure you subscribe and stick around, okay? Now let's keep going. I'm going to talk about a little bit about wages, all right? Now, wages don't rise as fast as assets, okay? And in my opinion, that's by design, right? But here's why. Companies aim to control labor costs as much as possible. Productivity gains don't always translate into like higher pay. Global competition keep wage growth moderate, okay? Meanwhile, investments compound. If you own stocks or if you own real estate, your wealth grows exponentially. If you rely on income from a job, then more than likely your growth is going to be linear, okay? You're going to have, moderate growth for the most part, if that, if you're depending on or if you rely on income. Okay, so that gap over time becomes massive. All right. So to put everything together, the Fed supports markets, inflation boosts asset prices, wages grow slowly, the wealthy own most assets. This creates, and it's almost like a cycle, it creates a loop. More wealth equals more investing, equals more gains, which in turn equals even more wealth. And it's not necessarily a conspiracy. This is not, some kind of conspiracy theory. It's how the system is structured. It's how it's been designed. But it does raise a serious question. Is the market truly reflecting economic health, or is it just amplifying inequality? All right. So what does that have to do, or what does that mean for you and me, basically? It means more than ever, understanding the system is critical. All right. We have to understand how this works. Because if you're just sitting on the sidelines, that means you're missing out on how wealth is actually built. Okay, or whether that's building it through investing, learning the financial system, or simply just staying informed. Okay, you need to play the game differently in 2026, or understand the game differently in 2026. If you found this helpful, like the video, subscribe to the channel, drop a comment. Do you think stock market is still justified right now? Or are we heading toward a correction? This channel is also about breaking down economics so that it actually makes sense to people. And remember, thank you again. Remember, Economics is your #1 source for everything econ. I appreciate you coming to view this video. I have more videos coming. Please stay tuned, and I'll see you on the next one. Thank you.